Hello, welcome to mergers and acquisition class. Make sure to subscribe to my channel and give this video a thumbs up. This topic is not very broad, so let me say that if you need the notes, like the theory aspect, you can send me a message, so I'll send the notes to you. It's just about 5 pages, you can read it. Okay, we have the introduction, like what is mergers and acquisition, types, reasons, criteria for selecting a target company, takeover strategies, reasons for high failure of mergers and acquisition, due diligence for mergers and acquisition, reverse takeover, defense strategies against mergers and acquisition, and the financial evaluation of mergers and acquisition. Okay, so this is the financial evaluation, like calculations, okay? But all these other ones are highly examinable, like the defense strategies against mergers and acquisition, due diligence, takeover strategies, criteria for selecting a target company. So I'm not going to start explaining all of that one by one. But mergers and acquisition is as a result of growth. So a company can try to grow organically, or it can achieve growth by mergers and acquisition. So merger is different from acquisition in the sense that when two companies merge together, let's say company A and B, a new company is formed. Okay, they lose their identity and a new company is formed. But when it's acquisition, one company acquires the other. So the financial evaluation in mergers and acquisition, that's what we'll be going to now, and it's very, very easy. Okay, the first thing you need to know how to calculate is synergy. The next thing is the net benefit to shareholders. The third thing is acquisition premium. And the fourth thing is the maximum price payable. Maximum price payable to acquire. That is that the predator company should pay. So that's what financial evaluation in mergers and acquisition will revolve around. Meaning that any question they ask you in exam will revolve around these 4 variables. Does that make sense? So let's start from synergy. Let me clean off the board. So what's the formula for synergy? Synergy means the gain on acquisition, okay? That is, as we combine now, what is the gain? Okay, if company A acquires company B, for example, what's the benefit on that acquisition? That's what it means. So the formula for calculating that is the post-acquisition value. Post-acquisition value of combined company minus pre-acquisition values of independent company. Post-acquisition value of combined company, that is when A and B now becomes one company, what's the value? Maybe it is now 20 million, and before acquisition maybe A was 10 million and B was 5 million. Okay, so very simple. So the synergy is the difference before and after. So this means the synergy is 5 million, but it's not as easy as it comes. Where the trick usually is when you now want to value the company, they will now give you different information on how you should value the predator company or the prey. You know, the predator company is the company that wants to acquire the target company. There is target company and predator company. Okay, so the target company is one that wants to be acquired. So sometimes they won't tell you the value of that predator company or the prey company or both of them. You now have to go and do the valuation, and that was why corporate valuation had to be treated before mergers and acquisition. Now the net benefit to shareholders is like, what's the gain to we shareholders? You know, the company is different from its shareholders now. Okay, so what's the gain to the shareholders? And the formula for that, hope you guys are writing. Please write in this topic because we have 2 questions to solve. So your net benefit to shareholders, the formula is your synergy minus acquisition premium. Right? Synergy minus acquisition premium. You know, synergy is what you've gotten in the beginning. That is what's the gain to the company. We said 5 million because the company acquired B, because company A acquired company B. It means there's a synergy of 5 million. Synergy can come in terms of cost savings, or it can come in terms of increased revenue. Majorly that too, right? So the synergy minus the acquisition premium. The acquisition premium is the extra amount paid on the value of the target company. If you tell that the target company is say 8 million and then the shareholders paid 9 million to acquire the company, it means that there's an acquisition premium of 1 million. Do you understand? It makes sense. So the synergy minus the acquisition premium will give you the net benefit to shareholders. Okay, I think I've explained that. Now the next thing is acquisition premium, and that's another variable in mergers and acquisition that is very important. The acquisition premium, and just like I've explained, is the purchase consideration minus the value of target company or the prey company, the company being acquired. Does it make sense? So maybe the value of the target company is 8 million. Most times you'll be the one to value this target company, and then the purchase consideration is like 9 million. It means the acquisition premium. Premium is like extra now. You know, it's not basic. They can't tell you that something is 8 million, you pay 8 million. You pay premium just to prove your goodwill. Makes sense, right? So that's value of target company. The money they pay above it is the acquisition premium. Then number 4 is the maximum price payable to acquire the target company. Now this is like, what is the maximum price that the shareholders of the predator company should pay? No, don't forget we're using company A and company B. So what is the maximum price that company A should pay, right? The formula for that, maximum price payable, that is, they must not pay beyond, okay, is what? Value of combined company minus value of predator company. That's company A. Does it make sense? So if you know that when you get married to a lady, you become 100%, but now you are 80%. It means 20% has been added to you because you got married. So you don't mind paying that 20% as the bride price. That's the concept, okay? Let's say after they acquire B, they will become 20 million. And before they acquire B, that is value of the predator company right now, is, let's say, 25 million. You can see that it is even a loss. So why acquire? But let's say now they are 8 million. And by the time they acquire, they will become 20 million. It means that that difference of 12 million naira is the maximum they will pay. The maximum benefits that should be added to you should be the maximum that you pay. You don't want to pay beyond the value being added to you. Does that make sense? Let me read the first question. I'll read it from my system here in case I'm looking down, but I'll also put it on the screen. So the question says, Maradona PLC is considering making a bid for 100% of Makanaki PLC's equity capital at a price of 7,350 million. Makanaki has a PE ratio of 14 and earnings of 500 million. It is expected that 150 million in synergy savings will be made as a result of the takeover, and the PE ratio of the combined company is estimated to be 16. Maradona currently has a PE ratio of 17 and earnings of 750 million. Required: calculate the value of Makanaki, the value of Maradona, the value of the combined company. 4. The premium payable, the gain from the acquisition, net benefit to shareholders, maximum amount that Maradona should pay for Makanaki, and the minimum bid that Makanaki shareholders should be prepared to accept. So you can see that A to C in the requirement is asking you to value the company. Okay, so corporate valuation is very important. And then the remaining part of the question is asking you on those formulas I just explained. After this question, we'll solve another example. That one is an ACCA question, a very big exam question that will write reports also. That's why I said you should carry your notes, right? So let's solve. Required: first they say you should do what? Value Makanaki. So here you know that the predator company is Maradona PLC, and the prey or the target company is Makanaki, the value of Makanaki. So how should you value it now? How would you value Makanaki? Based on the information they gave you, it means you're going to use what? The income basis method. And under the income basis method, you are using the PE ratio method. The information that they gave you helps you to know the method to use, because normally you should not know, right? So the PE ratio for Makanaki is what? It said here, sorry, I'm looking at my laptop. It said here that Makanaki has a PE ratio of 14 and earnings of 500 million. Okay, so 500 million. So 500 multiplied by 14, 500 times 14, that gives us 7,000 million. Okay, because the million of that is here. Do you understand? That means 7 billion. Okay, so the next part of the question says the value of Maradona PLC is equal to the PE ratio multiplied by the earnings. This one is a very simple example. The second one is harder. So the PE ratio for Maradona here is 17. Okay, 17, and they have a current earnings of 750 million. So 750 times 17, that gives us 12,750 million. Okay, then the C part of the question says, what's the value of the combined company? The value of combined company. So what did they say about the combined company? They said that it's expected that 150 million in synergy savings will be made as a result of a takeover, and the PE ratio of the combined company is estimated to be 16. So 16 multiplied by the synergy, that's the extra income they will make, 150 million, plus what is the value of Makanaki PLC before, 500 million, plus the value of Maradona PLC before, 750 million. So add all of that together, 150 plus 500 plus 750, that's 1,400 multiplied by 16, that will give us 22,400 million. Does it make sense? It does. So that's the value of the combined company. They could give you information so that you have to use a different approach, like free cash flow to firm. That's what we have in the next question. And for people that don't watch the next question, I cannot say that you've learned mergers and acquisition. The next question is very important. D, they said the premium payable, premium. And I've told you the formula for premium, right? Purchase consideration minus the value of the prey. The value of the prey, that's value of target, and the target is what? Makanaki. So the purchase consideration, what did they say about that? At a price of 7,350 million, right? So purchase consideration is 7,350 minus value of target company, that's Makanaki. Where is it? 7,000. Can you see? So they paid an extra premium of 350 million. Nice. Then the E part of the question says calculate the gain from the acquisition. Okay, gain from acquisition, that is the synergy, not gain to shareholders. Gain to shareholders, that's net benefit to shareholders, is different from the gain on acquisition. The gain on acquisition is the synergy, that is the gain to the company itself. Okay, so gain on acquisition, that's synergy, is what? Value of combined company minus value of independent companies, right? So the value of the combined company, you already have it as 22,400 minus the value of the independent companies before they even measured at all, 7,000 plus 12,750. Okay, so let's do that. Put that in your calculator, and that will give you 2,650. Right, 2,650 million. Right, the F part of the question, says the net benefits to shareholders. Net benefits to shareholders, that's what? Synergy minus acquisition premium. And you calculate your synergy to be 2,650 minus acquisition premium of 350. So, and that will give you 2,650 minus this, that will give you 2,300 million. Then last one says calculate the maximum amount that Maradona should pay for Makanaki. Right, let's write that up here. That's G, the maximum amount, that's the maximum price. I already gave you the formula, that is value after acquisition minus value before acquisition. Sorry for all this, my shortcut. So the value of the company, that is the combined company, what did the company become? It became 2,400 minus the value of the company, that's Maradona, 12,750. Put that in your calculator. 12,750 minus 22,400, that's 9,650. 9,650 million. So this is the maximum price payable. That is, they should not pay more than this price. Does it make sense? They should not pay more than this price. What price did they pay? Purchase consideration, where is it? 7,350. So it's still okay. If they had paid like 10,000, if they had paid like maybe, if they had paid like maybe 9,700, it would have been too much. They're already at a loss. So this is the maximum price payable, and see what they paid. So it's still okay. Then the next part of the question, which is the last one, let me see. It says calculate the minimum bid that Makanaki shareholders should be prepared to accept. Think about that. What's the minimum bid that the prey company, that's the target company, Makanaki, what's the minimum bid they should be prepared to accept? If they want to come and take over your company, the minimum bid should be the value of the company. So that one requires no calculation. Okay, so just say EFGH. The minimum bid equals the value of the company. value of the target company, right? And what's the value of the target company? 7,000 million. Okay, so that one does not require any calculation. So we are done with question 1. Now let's read question 2. That's the ACCA question. What year is it? I don't know the year it is, sure. But let's read it. I'm going to open it on my system here in case I'm looking down. Pursuit Co., a listed company which manufactures electronic components, is interested in acquiring Foda Co., an unlisted company involved in the development of sophisticated but high-risk electronic products.